Between 2018 and 2020, while Donald Trump was waging the most aggressive trade war with China in modern history, while tariffs were being slapped on hundreds of billions of dollars in Chinese goods, while both political parties were united in saying America would finally stand up to Beijing, BlackRock, JP Morgan, and Goldman Sachs quietly moved $1.4 trillion into Chinese markets. Not million, trillion, with a T. The peak year was 2020, the absolute height of the trade war, the year Trump was campaigning on getting tough with China, the year COVID originated in Wuhan, and anti-China sentiment hit fever pitch in America. That year, Wall Street moved more money into China than in any year in history. You might think this was a mistake, bad timing. Maybe Wall Street got caught off guard by the politics and couldn't pull out fast enough. But here's what you need to understand. This wasn't a mistake. This was the most predictable move in modern financial history. Because there's a pattern that's been repeating for over 300 years. A pattern so mathematically precise, so historically consistent, that once you see it, everything happening to American economic power right now becomes crystal clear. The global financial system doesn't run on chaos. It runs on a 4-stage mechanism that has destroyed every single reserve currency in recorded history. And right now, we're in stage 3 of 4. Let me show you how this works, how it's happened before, and why what Wall Street did during the trade war wasn't betrayal or stupidity. It was the script, the exact same script they followed every single time a currency system approaches collapse. Let's start with the mechanism itself, because once you understand the pattern, you'll see it everywhere. Stage 1, financial elites create a monopoly on money creation through a central bank. Stage 2, they use that monopoly to finance government expansion through debt. Everything looks great. The economy booms. The empire expands. Everyone thinks they've figured it out this time. Stage 3, the system overextends. The currency starts losing value. The government loses control. Cracks appear. But here's stage 4, and this is the crucial part. The same people who built the system move their money to the next rising power before the collapse becomes obvious to everyone else. The population gets left holding worthless paper while the architects are already positioned in the next empire. This has happened in Britain, in Germany, in America after 1971, and it's happening again right now. Wall Street pouring money into China while Washington puts on a show about getting tough with Beijing. Let me show you the historical precedent, because this pattern has never failed to complete itself. 1694, Britain. The country's at war with France. King William III is running out of money, the treasury is empty, tax revenue can't cover the war costs. A Scottish merchant named William Patterson comes up with a solution that will reshape civilization. He proposes creating the Bank of England. Here's the deal. A group of wealthy merchants will loan the government £1.2 million at 8% interest. But the loan will never be repaid. Instead, the government will pay interest forever, backed by Parliament's power to tax British citizens. And here's the genius. The bank will issue notes against this government debt. Those notes become money. The government's IOU becomes currency, circulating through the economy, and the wealthy subscribers to the bank, they collect interest on the nation's entire money supply. Stage 1 complete. A central bank with a monopoly on money creation, backed by government debt. Stage 2 kicks in immediately. Within 4 years, Britain's national debt explodes from £1.2 million to £16 million. By 1815, after financing the Napoleonic Wars through continuous debt-backed money creation, the debt hits £885 million. But Britain isn't collapsing, it's thriving. The Royal Navy becomes the most powerful military force on Earth. Britain colonizes half the planet. The pound sterling becomes the global reserve currency. International trade runs on British pounds. Foreign governments hold pounds as reserves. Everything looks unstoppable. Britain's on top of the world. But by the mid-1800s, the cracks start showing. British industrial production peaks and begins declining relative to Germany and America. The cost of maintaining a global empire grows faster than Britain can afford. The debt starts climbing again, faster than economic growth. And this is where it gets interesting. The same financial institutions that built the British system start moving their money somewhere else, America. British capital pours into American railroads, American steel, American industry. The Rothschilds, who had financed Britain's rise, start financing American expansion. They're building the exact same system in New York that they built in London. By the time Britain officially abandons the gold standard in 1931, by the time the pound collapses as the reserve currency, the architects have already repositioned. They moved the money before the collapse. Stage 4 executed perfectly. Second example, Germany after World War I. The Treaty of Versailles hits Germany with 132 billion gold marks in reparations. The Weimar government faces a choice. Raise taxes to pay it, which would be political suicide, or print money. They choose the printing press. The Reichsbank, Germany's central bank, starts monetizing government debt, paying striking workers, funding social programs, keeping the political coalition together. When France and Belgium occupy the Ruhr industrial region in January 1923 to seize coal and force payment, Germany's response is to pay Ruhr workers to strike, pay them with printed money. The money supply goes absolutely insane. May 1923, 8.6 billion marks in circulation. June, 17 billion. August, 669 billion. By November 1923, the money supply hits 400 quintillion marks. $1 US buys 4.2 trillion German marks. A wheelbarrow of cash won't buy a newspaper. Workers get paid multiple times per day because their wages are worthless by the end of their shift. The middle class gets wiped out. Savings evaporate overnight. And here's the part they don't teach you. This was an accidental policy failure. Rudolf Havenstein, the Reichsbank president, deliberately bought foreign currency with marks at any price, regardless of inflation. Later records confirmed it. The hyperinflation was useful. It eliminated domestic war debts. It destroyed the politically inconvenient middle class. When the crisis peaked, when Germany introduced the Rentenmark in November 1923 to stop the bleeding, the solution required American loans. The Dawes Plan of 1924 brought Wall Street into Germany to restructure everything. U.S. money flooded in through the late 1920s. American banks and corporations gained massive exposure to German industry. Then, when that system collapsed in the early 1930s, creating the conditions that brought the Nazis to power, those same American financial institutions were already positioned for the next phase. They got out before the political disaster. Same pattern, different century. Central bank monetizes government debt. System expands through inflation. Currency collapses. Foreign capital restructures during the crisis, then exits before the final catastrophe. Third example, the one that created today's system. July 1944, Bretton Woods, New Hampshire. Representatives from 44 nations meet to create a new monetary order after World War II. The US dollar gets pegged to gold at $35 per ounce. Every other currency pegs to the dollar. Foreign central banks can redeem their dollars for physical gold at that fixed rate. The dollar becomes the global reserve currency, backed by the largest gold reserves in history at Fort Knox. For 2 decades, it works. Europe and Japan rebuild using dollars. American economic dominance is total. But then the US starts using its ability to print the reserve currency to finance things it can't afford. The Vietnam War, Great Society programs, Cold War military buildup, all without raising taxes. The Federal Reserve expands the money supply. Dollars flood into foreign central banks as America runs bigger and bigger trade deficits. By 1971, there are way more dollars circulating globally than the US has gold to back them. France sees what's happening. Under President Charles de Gaulle, they start demanding gold for their dollars. Other countries follow. In August 1971, President Georges Pompidou sends a French warship to New York to collect French gold. Switzerland demands gold on August 9th. On August 11th, Britain asks for $3 billion in gold moved from Fort Knox. Paul Volcker, then Undersecretary of the Treasury, said later that when Britain, the country that founded the Bretton Woods system with the US, started taking gold for dollars, everyone knew it was over. By August 15th, only 10,000 metric tons of gold remained in US reserves. Not enough to meet redemption demands. August 15th, 1971, Sunday evening. Nixon goes on TV and announces the US is temporarily suspending dollar convertibility to gold. The gold window closes. That temporary measure is still in effect today, 54 years later. The Bretton Woods system collapsed. By March 1973, the world moved to floating exchange rates. The dollar became pure fiat currency, backed by nothing except government promise and US military force in global oil markets. Since that day, the dollar has lost over 98% of its value against gold. In 1971, gold was $35 per ounce. Today, it's over $2,600. Same pattern. System overextension, loss of monetary discipline, currency debasement, and the architect's repositioning before the collapse completes. So now let's apply this pattern to what happened during Trump's trade war, because once you see the mechanism, the $1.4 trillion becomes obvious. July 6th, 2018, Trump imposes the first tariffs on Chinese goods, $34 billion worth. The trade war officially begins. America's finally going to stand up to China. Rebalance trade, bring manufacturing back. Both parties support it. The media covers it constantly. The establishment is united in saying we're getting tough with Beijing. But July 6, 2018 is significant for another reason nobody talked about. It's exactly 1 month after June 1st, 2018, the day MSCI, the company that controls global investment indices, officially started including Chinese A-shares in its emerging markets index. Think about what this means. When MSCI includes a market in its indices, institutional investors who track those indices must put money into that market. Pension funds, sovereign wealth funds, university endowments, insurance companies, trillions of dollars that simply follow the index wherever it goes. China's weight in the MSCI Emerging Markets Index went from essentially zero in 2017 to 43% by October 2020. During the exact same period, 2018 through 2020, when the trade war was at its peak, U.S. portfolio investment in China hit $1.4 trillion. The peak year was 2020. The year COVID started in Wuhan, the year anti-China sentiment was highest, the year Trump campaigned on China being the enemy. That year, Wall Street moved more money into China than ever before in history. BlackRock expanded its Chinese operations throughout this entire period. In 2020, they got approval to operate a wholly foreign-owned mutual fund business in China. JP Morgan got approval for a majority-owned securities business in China in 2020. Goldman Sachs increased its stake in its Chinese joint venture to 51% in 2020. These aren't accidents. These aren't mistakes. This is the pattern executing in real time. Let's check the boxes against the four-stage mechanism. Stage 1, Federal Reserve established in 1913. Monopoly on money creation granted to a central bank. Stage 2, decades of debt monetization. The Federal Reserve finances World War I, World War II, the Cold War, Vietnam, Iraq, Afghanistan, the 2008 bailouts, COVID spending. The national debt goes from $400 billion in 1971 to $36 trillion today. The Federal Reserve's balance sheet was under $1 trillion until it was 8. It exploded to $9 trillion during COVID, still above $7 trillion today. Stage 3, system overextended. U.S. debt to GDP ratio is 132%. The annual interest payment on the debt is $1.2 trillion, more than the defense budget. The dollar has lost 98% of its purchasing power since 1971. The currency is debasing in real time. And stage 4, financial institutions moving capital to the next power center while Washington performs theater. We're here right now. Here's what people miss about the trade war. It was never designed to win. It was designed to fail in a way that looked like America was trying. You cannot fight China with tariffs, while your largest financial institutions are moving record amounts of capital into Chinese markets. You cannot reshore manufacturing, while the index providers who control institutional capital allocation are increasing China's weight in global portfolios by 43%. You cannot maintain dollar hegemony while running trillion-dollar deficits financed by central bank money printing. The contradiction is not an accident, it is the mechanism. The trade war gave political cover for what Wall Street was already doing. Trump could tell voters he was tough on China. Senators could give speeches about standing up to Beijing. And while all that theater was happening, BlackRock, JP Morgan, and Goldman Sachs were building China's financial infrastructure, integrating Chinese markets into global capital flows, and positioning for the next phase of the pattern. The British population didn't understand in 1880 that their capital was building America while London was still the global financial center. The German population didn't understand in 1929 that American banks had facilitated their hyperinflation cycle and positioned for the collapse. The American population doesn't understand now that Wall Street is building China's financial infrastructure while Washington performs resistance. But the pattern doesn't require your understanding. It simply executes. Here's the timeline of what happened. 2017, China announces plans to open its financial markets to foreign investment. This isn't random. This is negotiated with Wall Street firms who have been lobbying for access for decades. 2018, MSCI begins, including Chinese stocks in its indices. This triggers automatic capital flows. Trillions of dollars that track these indices must now include Chinese positions. July 2018, the trade war begins. Political theater starts. Media focuses on tariffs and tweets. Nobody's watching the money. 2019, China accelerates financial market opening. Removes foreign ownership caps on securities firms, insurance companies, mutual funds, Wall Street firms to get licenses they've wanted for 30 years. 2020, COVID hits, anti-China sentiment peaks, trade war intensifies, and Wall Street hits the accelerator. BlackRock, JP Morgan, Goldman all expand Chinese operations. Portfolio investment hits all-time highs. By 2021, the repositioning is largely complete. China is fully integrated into global capital markets. Wall Street has built the infrastructure. The next phase can begin. Now look at where we are today. 2025. U.S. debt still climbing. Federal Reserve still printing money to buy government bonds. Dollar still losing purchasing power. Trade deficit with China larger than it was before the trade war. And Wall Street already positioned in Chinese markets. Already building relationships with Chinese regulators. Already training Chinese financial professionals in New York banking practices. This is stage 4 in progress. And here's what happens next if the pattern completes, like it always has. The dollar loses reserve currency status, not overnight. Gradually, oil trades in yuan, countries settle bilateral trade in currencies other than dollars, central banks reduce dollar reserves, hold more gold, more yuan, more alternative currencies. The dollar doesn't disappear. It becomes one currency among many, like the pound after 1931. And when that happens, when the dollar is no longer the global reserve currency, all those dollars that foreign countries have been holding, they come flooding back to America. Trillions of dollars that were circulating overseas, financing global trade, held by foreign central banks as reserves. They return home because nobody needs to hold dollars anymore if dollars aren't the reserve currency. That's when inflation really hits. Not the 8% we saw in 2022. Real inflation. Double digits sustained, maybe higher. And Wall Street? They'll be fine because they already moved the money. They're already positioned in Chinese markets, in Asian markets, in the next power center. The American middle class holding dollar-denominated assets, holding treasury bonds, holding savings accounts, they're the ones who get destroyed. Just like the British middle class in the 1930s, just like the German middle class in 1923. The pattern does not care about your political preferences. It does not care whether you believe in American exceptionalism. It does not care about technology or AI or any other narrative designed to explain why this time is different. This time is not different. The mechanism is mathematical. When a monetary system is based on debt creation, when the entity that creates money is separate from but dependent on the entity that taxes, when the system expands beyond productive capacity, the currency debases. And when the currency that debases is the global reserve currency, the architects of that system move their capital before the collapse completes. So what do you do with this information? You understand that the machine is already in motion. You understand that by the time this becomes obvious to the mainstream, by the time CNBC is talking about it, by the time your neighbors understand what happened, the repositioning will already be complete. You understand that the current system, the dollar as reserve currency, American financial dominance, the post-Bretton Woods order, is not permanent. It is stage 3 of a 4-stage pattern, and stage 4 is executing right now. You position yourself accordingly. You understand that holding assets denominated purely in a debasing currency is a choice to participate in the transfer mechanism. You understand that the inflation is not temporary, not transitory, not the result of supply chain disruptions or Putin or greedy corporations. It is the predictable outcome of monetary expansion disconnected from productive growth. And you understand that when they tell you not to worry, when they say this time is different, when they claim modern financial engineering has solved the problems that destroyed previous systems, they are either ignorant of the pattern or complicit in its execution. The next 5 to 10 years will not look like the last 30. The mechanism is accelerating. The debt cannot be repaid. The currency will continue to debase. The financial elite are already positioned. The only question is whether you understand the pattern clearly enough to see it happening in real time and make decisions that account for the inevitable outcome. This is not prediction. This is pattern recognition. The same mechanism that moved British capital to America in the 19th century, the same mechanism that moved American capital into Weimar Germany before the collapse, the same mechanism that moved capital out of the US as Bretton Woods failed, is moving capital into China right now. While politicians argue about tariffs, while think tanks debate decoupling strategies, while the media obsesses over trade war optics, Wall Street has already decided. $1.4 trillion has already moved. And the pattern, which has never failed to complete itself, is 3/4 through its execution. The population will hold the currency as it approaches worthlessness, while the architects of the system have already moved their wealth to the next power center. That is the pattern. That is the mechanism. And that is what happened during Trump's trade war while everyone was watching the wrong thing.